Samir Shah, MD and CEO of the National Commodity and Derivatives Exchange Limited. Shri Samir Shah was awarded the CEO of the Year Award at the Banking and Financial Awards held in Mumbai. Before NCDEX, Shri Samir Shah was the Chief Business Officer of the Dubai Gold and Commodities Exchange, DGCX. At DGCX, he led the growth of the exchange to make it one of the fastest growing exchanges in the world, including being awarded the Contract of the Year and the Best Commodity Exchange Award in 2012. Shri Samir Shah has more than 2 decades of experience in building institutions and market infrastructure. Prior to joining DGCX, he was the CEO of Mumbai-based Universal Commodities Exchange. I now invite Shri Samir Shah to speak on the SEBI-FMC merger, exploring the potential of a unified commodities and equities market. Ladies and gentlemen, Shri Samir Shah.
Good evening, everyone. Distinguished members on the panel and distinguished people in the audience, ladies and gentlemen. It's a pleasure to be here. So I'd like to thank BSE, NIPFP, and Indian Merchants Chamber for having put this event together. Which is it's a very opportune moment to reflect on the implications of the budget in a particular lens and to think and brainstorm what that means and what might be the shape of things to come in the future. I'm going to take a few minutes to put a slightly narrow lens in what I like to call as the outback of financial services, which is the commodity markets. So it's even a privilege and for me, and I'm sure Singalji, who's here in the audience, to be considered in the sort of the elite world of financial services. Commodities is usually, especially in India, it's been traditionally viewed as a good punching bag. Whenever there is inflation, you blame the commodities exchanges. When farmers don't get remuneration properly, you blame the commodity exchanges. When inflation goes high, you again blame. When crisis like NSEL happens, you again blame the commodity exchanges. So it's seen the sort of the worst of many worlds in that sense. So I'd like to give a slightly different spin to this whole aspect of commodity markets and throw some light as to what has really gone on in the commodity markets over the last few years, and what do I actually see happening from, if I were to put put a hat and sort of dream about what might happen in the next 3 years. Just 3 years, not even say 5-10 years, but just take a hat of 3 years and say what might this market look like under a stronger, autonomous regulator like SEBI. And under a stronger piece of legislation like the Securities Contract Act. It's good to dream, it's good to think of possibilities, and because action starts with thought. So let's start the thought process today and see what kind of action that leads to. So I'm going to just take a journey for the next few minutes to take you through some of the aspects of commodity markets, at least from my perspective. And I apologize, Singalji, that it may not cover sort of the bigger slice in the markets, which is the MCX slice. I can talk with confidence about what I see. So I'd like to share that with you. There's been a mini revolution happening in commodity markets over the last 10 years, and it's slowly creeping up. And I'll talk more about how it has real economic relevance to the country, although going unnoticed to a large extent. So it's very important for us to understand what is the impact it is having on the real economy. And if it is having that even limited impact on the real economy today, under a much stronger regulator, under a much stronger, credible piece of legislation, it can do wonders for the real economy in terms of balancing the way the resources get used. And I look at the commodity markets as nothing but resources. If you look at the 4 factors of production, land, labor, capital, entrepreneurship, under land and expanded definition of land, you will include natural resources in that. So a more efficient management of natural resources between producers and consumers, if that is the simple sort of vision of commodity markets, which is a more efficient allocation of resources between producers and consumers, then it can have a significant impact on on the economy. So the markets have actually grown quite significantly since launch in 2003 when the commodity markets were launched. Obviously, if you see the top bars, they're lower than the ones in 2012 and 2013, and that's largely reflecting the massive drop in commodity prices that have happened over the last 24 months. So with the fall in crude, global agri production has been at an all-time high. So most agri crops are trading at all-time lows. Cotton, sugar, edible oils, crude obviously is a well-known story. So it's more reflected in the price of commodities than the actual activity. So I'll just leave the last couple of years to the bearishness in the overall commodities. But if you trace the history from 2003 when it started, significant progress has happened in the industry. As Ashish mentioned earlier, the role of the exchanges is not just about trading patterns, and I'm a firm believer in that as well. The exchanges' role is, like in the capital markets, it's about channelizing capital from capital deficit, from capital surplus organizations to capital deficit entities. Likewise, the role of commodity exchanges to channelize resources from producers to consumers. So one of the metrics that is very important to track is deliveries on exchanges, and in that sense, I think the Indian commodity markets are very unique. Worldwide, deliveries are very, very marginal in futures markets in commodities because the underlying spot markets are very, very well developed. In India, that's not the case. In India, whether we like it or not, it is the derivatives markets, the futures markets that actually work backwards and help develop the spot market, which should have been the other way around. And I think the markets have done a great job over the last 10 years to facilitate deliveries and to force convergence between the physical spot markets and the sort of financial futures markets. So you can see the level of deliveries that have gone up in the exchanges is quite phenomenal, and it plays a very critical role. It plays an extremely critical role. So the pulses, the cereals that we have in our dining rooms at the end of the day, the prices that drive the food that we eat is driven by this one simple aspect of deliveries on exchanges that force the convergence between financial futures and the spot markets. So a tremendous development has happened on that front, and it is a sort of silent revolution, as I keep saying. How has the financial futures market in commodities transformed backwards and transformed the physical markets, which is quite interesting to see. We've had a small experience of a project that's happening in Karnataka, which is revolutionizing the APMCs and the mandis in the country, in the state of Karnataka, and that's another sort of excellent piece of reform and legislation that is appearing in the finance bill. If one looks at the detail, it talks about creating of a national agri market. The economic survey talked about that, and it's quite challenging to create a national agri market in the country, given the federal structure, which is the central sort of structure, and the state and the various constitutional complexities associated with that. But if you see what is going on in a place like Karnataka, where more than 50% of agri produce in a state like Karnataka is now going through electronic mandis, which is fascinating. I mean, it's not seen somewhere. If you talk about this to any sort of any of the sort of farmers who bring produce to the mandis, and they will say that this is a great thing to have, and it's a silent revolution. If we can imagine replicating this under a mature regulator and under and a more mature piece of legislation, which is the Securities Contract Act, and you can see this replicating at a national scale, you can see the kind of impact it can have on creating truly a national agri market for this country. Likewise, procurement. So I talked about how markets can be used as an efficient way of channelizing resources from producers to consumers. we've had these sort of experiments of working and applying market concepts to how state agencies and federal central agencies in their online procurements for commodities. So when the country runs welfare programs like minimum support price, public distribution of public distribution schemes like sugar PDS, and if they are run efficiently, this has the potential of saving a huge amount of money for the national exchequer. And it's already happening. This is not a pipe dream. This is stuff that's already happening today. The question is, if these are happening in a sort of scattered way, subscale way, in pockets of the country, if they come under a mature regulator, which is what my repeated point is, under a mature piece of legislation, the kind of far-reaching impact it can have on the country's economy and growth opportunities for the markets is quite phenomenal. So there are 7 states today, 4 have already benefited, 7 states today in the country that actually procure their PDS sugar from online markets, which are regulated by the regulator. How do you channelize finance through these systems? How do you create? I mean, we have a situation where priority sector lending is a key target for the government. We have a situation where the banking sector is incentivized and almost, not just incentivized, forced to lend priority sector lending. And despite that, you have a situation where banks prefer to pay the penalty on their defaults on PSL, on priority sector lending, by putting them in certain other schemes and bonds, but not actually putting money where it matters. And why is that happening? That's because banks don't trust the institutional mechanisms in the warehousing and in the commodity infrastructure and in the agri infrastructure, so that they can lend their money, and be assured of the right risk-reward return. But if all that were to be channelized through a regulated infrastructure, I believe that banks would be very confident, far more confident than they are today, and it could solve the burning problem of ensuring that the priority sector lending goes into the areas that it needs to go to. Another sort of example is how FMC has had tremendous vision in introducing what was the physical market physical market traded forwards onto the exchange. And if you can take a simple, I'm not going to go in the complexity of the slide, but in very simple way, if the minimum support program, MSP program that's run by the government through agencies like FCI and NAFED and SFAC, if it can be run through regulated markets, it has a tremendous opportunity to save costs that are incurred by institutions and corporations like FCI that incur significant amount of wastages and inefficiencies in the way the business is being run. We've sort of quantified savings that are potentially possible if a program like MSP is run through a regulated marketplace, and that's the vision that we think is really possible through a SEBI-FMC merger as you extrapolate 3 years down the line. So just to summarize, the basic social purpose remains the same for commodity markets, which is akin to other markets, as Ashish pointed out. It is bridging the gap between producers and consumers, and it is making sure that resources reach from producers, consumers in the most efficient possible manner. We believe that a single regulator between commodities and securities under SEBI, once the finance bill gets passed in the parliament, will enable this, and it will create a tremendous opportunity to impact the real economy and at the same time bring a huge amount of growth for the market and growth opportunities for the market. Just to give you an example, that in well-developed markets, if you look at the metrics of the amount of trading in derivatives markets that happens on commodity exchanges worldwide as a factor of the production of those commodities in those countries, and you apply those same metrics to India, and let's say that in 5 years from now, we can aspire to have at least 50% of those metrics, not even 100%, 50% of those metrics. We think that the commodity markets can grow by a factor of 12 times. And that can happen. So that's growth for all of us, growth for all of us sitting here. But growth the growth comes with a real social impact that's delivered by the marketplace to the real economy and to the country, and which is extremely important. One can't ignore financial markets cannot exist in isolation. economy, and there has to be that strong link between real growth in real economy versus growth in the financial markets. So a single regulator, a single law will create faster growth. It will bring significant efficiencies for market intermediaries, as Ashish pointed out, in terms of simple KYC norms, single balance sheets, simple ways of accessing these markets. But for me, the most important aspect is that it unleashes efficiencies that can solve real structural problems for the country, bring real growth in the economy, and at the same time create growth in the financial markets that most of us do represent. So I think it sort of kills two birds in the same stone, and very, very big sort of far-reaching consequences through that. So to sum up, at NCDEX, we are quite excited about the potential of this, and I'm sure sort of likewise my other colleagues in the commodity markets are looking forward to this change. I'd love to talk more about this through the questions and answers or any other sort of interactions as possible. I'd like to thank again BSE, NIPFP, and IMC for giving me the opportunity, and for all of you to patiently listen to the few things that I've had to say. Delighted to be here. Thank you.